Every couple of years, the US government shuts down. It seems like it's happened a lot lately. But in this video, we want to explore how the shutdowns actually impact the economy and the financial markets, and what you as investors should do as a result. Despite the noise, especially in the news, markets have generally remained pretty resilient to these shutdowns in the past. They create all sorts of drama. It seems like all sorts of things are happening, especially when it comes to workers being furloughed and government operations stopping. But generally, they have relatively short-lived economic effects, which is really reassuring if you look back at history. We're going to explore in this video a little bit more about what you should do as a result, what you should pay attention to, and what types of strategies can maintain your financial security through what might seem like really uncertain times. Hi, I'm Justin Kuntz, Managing Director at Pacific Wealth Management, helping you make good financial decisions through sound management for a secure future. So what is a government shutdown? You see this all over the news, but what actually happens? Well, in Congress, when a government shutdown occurs, it really is because the Republicans and the Democrats can't come to an agreement on a spending bill. And that results in a shutdown after a certain period of time. When that occurs, funding for non-essential services and workers stops. Essential services and funding continue, things like Social Security, national defense, that kind of thing. But non-essential services actually cease funding completely. And certain workers have to be furloughed. Other workers even continue working, but without pay. Things like TSA and that sort of thing. But for investors, the important thing to remember is that shutdowns are not new, and they have historically had very little long-term impacts on markets. Since the 1980s, we've actually had 10 government shutdowns. They've ranged from a single day to the record-setting 35-day shutdown that took place in 2018. While these events can disrupt government operations, their direct effect on the economy has been relatively modest. Looking back at history provides a valuable perspective. During the 1995 to 1996 shutdown under President Clinton, which lasted 21 days, stocks were roughly flat during the shutdown and were higher over the subsequent year. In 2013, during the shutdown that lasted 16 days under the Obama administration, stocks rose modestly during the shutdown and continued higher soon after. Even the longest shutdown in 2018 and 2019 tells the same story. The shutdown lasted 35 days, but the market actually rose 10% during that period. Broader trends such as the Federal Reserve policy and trade developments had a far greater influence on investor behavior than the political standoff itself. So what's the takeaway? Brief volatility might occur during these shutdowns, but actually stocks usually tend to respond towards what is going on economically rather than the drama in Washington. Long-term fundamentals, things like earnings, growth, Federal Reserve policy, oftentimes drive markets. So these short-term events in the government have relatively little impact. JP Morgan's head of global rate strategy, Jay Barry, put it clearly when he said that government shutdowns have historically limited implications for financial markets because investors focus on long-term macroeconomic trends rather than short-lived budget disputes. In other words, while the political process may appear chaotic, the underlying economy continues to function. So I think it'd be helpful to break down what segments of the market react in different ways during government shutdowns. This is important as any investor that's exposed to many asset classes. Stocks generally have small bouts of volatility during government shutdowns, but as we've seen from previous reports and what's happened in history, they usually bounce back relatively quickly because they're focused on what's going on with earnings, economic trajectory, and that sort of thing. In the bond market, the effect is slightly different. Short-term treasury yields can rise modestly during a shutdown because investors may worry about delays in government payments. At the same time, longer-term government bonds often see an increase in demand as investors seek safety, which pushes the prices higher. US dollar generally remains stable, maintaining its safe haven status. We've very rarely seen in the past any kind of doubt around the US dollar being the global reserve currency, at least for now. And so, that's generally remained stable during government shutdowns as well. And all in all, as we've said, markets have remained stable. We might see a little bit of volatility, but they usually bounce back quite quickly and overall are pretty unaffected by these government shutdowns in general. Now, shutdowns are not completely harmless. Certain services within national parks, research departments, those kinds of things stop working. So one effect that is relatively substantial and worth considering is the effect on the BLS and Commerce Department. and how those stop working. And essentially their data feeds around employment and what goes on within the commerce within the US, they don't go to the Federal Reserve Bank. So the Federal Reserve Bank has limited access to the research that they normally analyze to make decisions along the way. So what happens during government shutdowns and briefly after are generally cautious tones out of the Federal Reserve. They're not making as many decisions with conviction because they have relatively limited information during that time. So theoretically, if a government were to remain shut down for a truly extended period of time, talking maybe half a year or something like that, that would probably impact fiscal policy substantially and might impact the economy. However, we've never really had that happen in the past, so hard to draw any conclusions. Historically, economic growth slows slightly during a shutdown, but then catches up as deferred spending and activity return to the system. When we step back, the message from decades of data is clear. Financial markets view shutdowns as temporary interruptions rather than major threats. They create volatility, but that volatility usually passes once the situation is resolved. And investors who react emotionally and sell during these periods often miss the recovery that takes place soon after. Corporate earnings, monetary policy, and global demand are the true drivers of long-term market performance, not what happens politically in Washington. While political gridlock may capture headlines, it rarely changes the fundamental trajectory of the economy itself. So, what should investors focus on during times like this? The answer is discipline. The best strategy is to maintain a long-term perspective, stick to a diversified portfolio, and avoid reacting to short-term government news. The US remains a global economic powerhouse with strong institutions, dynamic companies, and deep financial markets. Over time, that resilience has repeatedly outweighed the effects of short-term political conflict. Let's close with a few key takeaways. First, history shows us that shutdowns have limited and short-lived effects on financial markets. Stocks may experience small declines, but they tend to recover quickly once uncertainty clears. Second, bonds in the US dollar generally behave predictably, with investors moving temporarily to safer assets without fundamentally changing their strategy. Third, the broader economy remains resilient because essential operations continue and consumer behavior changes very little during a shutdown. And finally, investors who stay focused on long-term goals rather than reacting to short-term political noise are consistently rewarded with steadier results. The next time a shutdown hits headlines, remember, history has already shown a likely outcome. The disruption will pass, the government will reopen, and markets will continue to focus on the same forces that have driven them for many decades: earnings, growth, and investor confidence. By focusing on the structure, diversification, and long-term planning, you can navigate temporary uncertainty with confidence. I'm Justin Kuntz, Managing Director of Pacific Wealth Management, and if you're interested in seeing more about how we help our clients make the most out of their life with their money, be sure to visit us at www.pacwealth.com. Thanks.